Hello, welcome to Module 15. In Module 15, which is the statement of cash flow, it's an oldie but a goodie. Statement of cash flow, we have a very, very nice handout for you. It begins on page 15, and it goes pages 15, 16, 17, 18, 19, and 20. So what I would like you to do is get out your financial accounting reporting handout and turn to page 15. At the same time that you get your handouts out and you look on page 15, we're going to also take a look at page 616, which is the beginning of Statement of Cash Flow, which is Statement of Financial Accounting Standards number 95. Now, if you were to look that up in the current text does not have it under Statement of Cash Flow. They actually have it under, here's my current text here, is if it's topical, it would be under the cash flow statement. Yeah, it's under C25 for a cash flow statement. Anyway, so it's like cash, okay, instead of statement. All right. For the statement of cash flow, the statement of cash flow is one of the three principal financial statements. You prepare it third. There's two other principal financial statements. The first one you prepare is the income statement, then the second one you prepare is the balance sheet, and then finally you prepare the statement of cash flow. So those are your three principal financial statements. Of course, you know there are other financial statements besides those three principal financial statements. We also have the statement of comprehensive income, and we also have the statement of shareholders' equity, or statement of changes in shareholders' equity. We also have a statement of retained earnings. But those are not principal statements. The principal financial statements are the income statement, the balance sheet, and the statement of cash flow, and they are prepared in that order. Please do not forget there is also the footnotes. Remember, the footnotes are an integral part of the financial statements. Now, what we have here beginning on page 15 is actually, this is a very nice handout. That kind of it's like a guide for professors, and we like it because there's a lot of white space and it gives you room for you to take your notes, so we like it because of that reason. So let's take a look then at the statement of cash flow beginning on page 15. At the same time, you're going to eyeball page 616. When it's time to go to the book, I'll tell you. On page 15 of your financial accounting reporting handout, at the top it says the statement of cash flows, module 15. Objectives and purpose of the statement of cash flows. It is to provide information about cash receipts and cash payments, and I want you to write there for the period. It does cover a period of activity. Then you're supposed to disclose information about financing and investing activities for the period, and to help users make assessments. Okay, so when I say that it's for the period, it's because the income statement covers an entire period of activity, which is from the beginning of the year to the end of the year. The balance sheet is as of one day, and then the statement of cash flow itself also is during a period of activity. Okay. Now, remember that it'll help users make assessments. When it says item number 3, helps users make assessments about the amounts, timing, and certainty of future cash flows. Amounts, timing, and certainty of future cash flows. Okay. So, letter B says, it's to help you explain changes in cash and cash equivalents. The statement of cash flow is not just a statement of cash flow. It's also called the statement of cash and cash equivalents flow. Because typically on the balance sheet, when you look at page 132 in your classified balance sheet, if it says let me see what it says here. It's module 70. Wrong one. Okay. If you look on page 132, which is where our statement of cash flow is, it says cash and bank deposits. Well, really, when they're talking about cash, they're also including cash equivalents, because it's equivalent to cash. Now, if they say cash equivalent, they just mean cash equivalent. There's certain items that say cash equivalent, but typically the cash equivalents are rolled into that first line there where it says cash and bank deposits. Now, when we talk about what is a cash equivalent, if you look at your handout on page 15, number 1 says cash and cash equivalents include short-term highly liquid investments that are A, readily convertible to known amounts of cash, B, so near the maturity, meaning 3 months or less or 90 days or less, that they present a negligible risk of changes in value due to changes or fluctuations in interest rates. So they have to have an original maturity. That means their maturity at the time that you purchase them has got to be 90 days or less or 3 months or less, okay? If you buy a 4-month item and you'll wait for 1 month to tick by so that it matures in 3 months. That is not a cash equivalent. That is considered to be a short-term investment. Cash equivalents have to have an original maturity of 3 months or less, or 90 days or less from the date of purchase. Examples of cash equivalents, they give you some examples here. They call them treasury bills, commercial paper, and money market funds. To that, you have to write another one, and that is certificates of deposit. Once again, the examples of cash equivalents are treasury bills, commercial paper, money market funds, and CDs. Okay, that's certificates of deposit. All right, let's see if we can take a look at a couple of multiple choice questions on this. We're going to take a look at multiple choice questions number 1 and 2. Multiple choice questions number 1 and 2. These are found on page 626. We had talked a little bit about cash back in Module 10 when I did monetary current assets and current liabilities. If you have a bank account in Bank A and a bank account in a different bank, and one account is positive, meaning it has cash in it, and the other one is negative because you took your overdraft protection on it, so it went negative. If they're in two different banks, two different companies, then Bank A that's positive is cash, but Bank B, which would be negative, that would be considered to be a short-term payable, a current liability. However, if you have account number 1 and account number 2, and they're both in Bank A, the same bank, and if account number 1 is positive and account number 2 is negative, and they're in the same company, in the same bank, then you are allowed to net them together. Okay, so that's something that's a little bit tricky about cash and checking accounts. If you take a look at, we're going to take a look at multiple choice numbers 1 and 2. Multiple choice number 1 says, Kale classifies investments with original maturities of 3 months or less when as cash equivalents. That's 3 months. An original maturity is 3 months or less when you purchase it. That, by the way, also is considered to be a disclosure that you have to give. We talked about this a little bit too in Module 7D when I talked about what types of disclosures go in your significant accounting policies. Back in Module 7D, I said things that go in your significant accounting policies are your definition and treatment of cash equivalents, and this is a definition and treatment, which we classify investments with original maturities of 3 months or less as cash equivalents. That's an original maturity when you purchase it, right? And then you would give the examples, and the examples would be commercial paper, treasury bills. Notice I say treasury bills. I don't say treasury notes. I don't say treasury bonds. Also money market funds and certificates of deposit, all with an original maturity of 3 months or less from date of purchase as a cash equivalent. You would put that in your significant accounting policies just like that. Okay. Other things, remember, that went into the significant accounting policies were whenever you have choices between alternative accounting treatments such as FIFO, LIFO, or average, you would tell them which one you chose and put it there. Straight line, double declining balance, some of the years digits depreciation, you say, oh, we use straight line, you put it there. Okay. For construction accounting, percentage of completion or completed contract, just say we use percentage of completion, you would put it there in your significant accounting policies. Anyway. So, in its December, I'm reading number 1, still on page 626. In its December 31st, 2008 balance sheet, what amount should Kale report as cash and cash equivalents? At December 31st, 2008, the Kale Company had the following balances in the accounts it maintains at the First State Bank. Checking account number 101 is $175,000. Checking account number 201 is negative $10,000. Are you allowed to net these things? And the answer is yes. You can net them, but only because they are both at the same bank, which is the First State Bank. If they were in two different banks, two different companies, you would not be allowed to net them. You have a money market account, that's $25,000, that's a cash equivalent. They have a 90-day certificate of deposit, that's due on February 28, 2009, that's a cash equivalent. What about a 180-day certificate of deposit? No, that is not considered to be a cash equivalent because it's greater than the 3 months or 90 days. So that doesn't count. That is just a short-term investment for the $80,000. So then Kale classifies investments with original maturities of 3 months or less as cash equivalents. In its December 31st, 2008 balance sheet, what amount should Kale report as cash and cash equivalents? Well, you would include the 175 and you would net it against the negative 10. So that's 165 plus the 25 plus the 50 is a total of 240. So the cash equivalents are 240,000, and the best answer there as cash and cash equivalents would be the 240,000. The answer is C, and that's typically the first line that you see on the balance sheet. They do say sometimes they call it cash, and sometimes they also call it cash and cash equivalents. The cash equivalents are rolled in there. Why? Because they are cash equivalents. They're equal to cash. All right, let's take a look at multiple choice number 2. Number 2 says the primary purpose of a statement of cash flows is to provide relevant information about what? The primary purpose of a statement of cash flow is to provide relevant information about, how about drop down to letter D, an enterprise's ability to meet cash operating needs. Well, that's true, all right? That is true. But, you don't necessarily pick the right answer. You have to choose the best answer, okay? Actually, I really, really like this problem because it has technically 4 correct answers, but you have to choose the best answer. The reason that letter D is not the correct answer is because we will learn that the statement of cash flow actually has 3 sections. The 3 sections are the operating, the investing, and the financing section. So when they say its ability to meet cash operating needs, that would just be the operating section. What about the investing and the financing sections? So that's not the answer. If you look at answer C, the cash receipts and cash disbursements of an enterprise during the period. That is actually the correct answer, is answer C. Now let's take a look at answer B. An enterprise's ability to generate future positive net cash flows. Well, the thing is, they may also be generating negative cash flows. And not only do they tell you about the future cash flows, they also tell you past, because remember, this is all historical data, and it covers the period, and we're all reporting this after the fact. So B is still a correct answer. It does help you do that, but what about the past cash flows? And then answer A says the differences between net income and associated cash receipts and cash disbursements. We do reconcile net income from the accrual basis to the cash basis of accounting, but that's just one section of the statement of cash flow. That's in the operating section when we present the indirect method of presentation, and we'll see that. So the best answer for number 2 is answer C. The primary purpose of the statement of cash flow is to provide relevant information about the cash receipts and cash disbursements of an enterprise during the period. Okay, let's go back to our handout. If you take a look at our handout on page 16, we do classify our statement of cash flows into 3 sections. The 3 sections are the operating activities, the investing activities, and financing. So operating, investing, financing. O-I-F. It's like alphabetical, but it's backwards, and you do have to know the correct order in the event that you have to do a statement of cash flow, all right, on the exam as a simulation, which, by the way, I do assign a simulation, and I'm going to finish up this hour, and then in the next hour I will start off with writing all the multiple choice in the simulation for you to do. But so the 3 sections are the operating activities, the investing activities, and the financing activities, which are on page 16, okay, of your handout. Now, if you notice that the investing activities, item 2, talk about the inflows of activities and the outflows of activities. The financing section talks about the inflows of activities and the outflows of activities. But if you look at the operating section discusses the indirect method of presentation and the direct method of presentation. That's because on the statement of cash flow, they do have 2 methods of presenting the statement of cash flow. The 2 methods are the direct method of presentation and the indirect method of presentation. What I'm going to do is point out to you what are the required disclosures for the direct method of presentation versus the indirect method of presentation. There's also required disclosures that apply to both methods of presentation. Okay, so what happens here is I'm going to say there's actually 5 disclosures. This is going to be for both methods. This is for the indirect method of presentation. This is going to be for the direct method of presentation. For both methods of presentation, they both have to disclose their policy and treatment and definition for cash equivalents, which is just what I went over with you in multiple choice number 1. Okay? They also have to disclose their significant non-cash investing and financing activities. Investing and financing activities. So this applies to both the direct method and the indirect method. Number 1, for both methods, the direct method and the indirect method, they have to disclose their policy, treatment, and definition for cash equivalents. They disclose this in their significant accounting policies. Then item number 2, they do have to disclose the significant non-cash investing and financing activities. This is for both methods. For the indirect method, they have to disclose 3, 4, income taxes paid, and interest paid. For the indirect method of presentation, they have to disclose the income taxes paid and the interest paid. For the direct method, they have to disclose a reconciliation of net income to cash from operating activities. Once again, they have to disclose a reconciliation of net income to cash from operating activities. And this is really very important. And the reason is because of this disclosure, nobody does the direct method. The direct method is actually FASB preferred. But it is the indirect method that is prevalent in the industry. That means when I say it's prevalent in the industry, that's the one that everybody does. Okay. So what is then the difference between the direct method and the indirect method for the statement of cash flow? Well, remember that I told you that the statement of cash flow was the third statement that they do in articulation. Remember, you do the income statement, then you do the balance sheet, then you do the statement of cash flow. What's going to happen is, let's just say that this is the balance sheet. Just pretend that it's equal. Assets equals liabilities plus shareholders' equity. And then here you have your income statement. And we'll just say that this is the revenues minus the expenses equals your net income. Then you close your net income into retained earnings, which is part of shareholders' equity. The thing is this. The three sections of the statement of cash flow, which you see on page 16 of your handout, are the operating section, the investing section, and the financing section. So here you have your balance sheet, and here you have your income statement. On your income statement, you basically have your revenues minus your expenses to give you your net income. And you can see this side is the same as this side. Net income is equal to the revenues minus expenses. And here you see that the assets are equal to the liabilities and the shareholders' equity. The thing is this. For the operating activities do focus on what's going on in the income statement, which is the revenues minus your expenses gives your net income, and your net income gets closed into shareholders' equity. So they look at what's going on the income statement for the operating activities. The only difference between the direct method of presentation and the indirect method of presentation is the way they present the operating activities section, and also the disclosures are slightly different. Okay, so the operating activities are different and the disclosures are different between the indirect method of presentation and the direct method of presentation. In the indirect method of presentation, which looks at things indirectly, they start off first with net income and they do a reconciliation, and they convert net income from the accrual basis to the cash basis, and they put this in the operating section. So the income statement is all about the operating section. Now, remember that the other side of the income statement is the revenues minus the expenses. If they take each revenue and convert it from the accrual basis to the cash basis, and each expense and convert it from the accrual basis to the cash basis, and they put that in the operating section, this going in the operating section is considered to be the direct method of presentation. And if they put the net income and convert net income from the accrual basis to the cash basis, and they put that in the operating section, that's considered to be the indirect method of presentation. So, once again, if you look back at your handout on page 16, there's only two differences between the indirect method and the direct method of presentation. The first difference is the way they present the operating activities. The investing activities and the financing activities are exactly the same for the direct method and the indirect method of presentation. The only difference is the operating activities, the operating section. In the operating section, the indirect method of presentation looks at net income and converts net income from the accrual basis to the cash basis. In the direct method of presentation, the operating section looks at the revenues and the expenses and converts those from the accrual basis to the cash basis. But you see that each one would be equal. Now, for the indirect method of presentation, if they choose to put the reconciliation of net income from the accrual basis to the cash basis in the operating section, that would be the indirect method presentation. And then for disclosures, they have to disclose taxes paid and interest paid. If you choose the direct method of presentation and choose to take each revenue and each expense and convert it from the accrual basis to the cash basis and put that in the operating section, for the direct method of presentation, you have to disclose a reconciliation of net income to cash from operating activities. You're probably going, what? If you choose the direct method of presentation, you actually end up converting both sides of the income statement equation from the accrual basis to cash basis. For the direct method of presentation, you take revenues minus expenses, each revenue and each expense, convert it from the accrual basis to cash basis. You put that in the operating section, but then you take this and convert net income from the accrual basis to cash basis and put it as a disclosure. So that's why FASB prefers it, because you convert both sides of the income statement, revenues and expenses, from the accrual basis to cash basis, and net income from the accrual basis to cash basis under the direct method of presentation. Under the indirect method of presentation, in the operating section, you take net income and convert it from the accrual basis to the cash basis, and then you only have to disclose two little items, which is taxes paid and interest paid. Interest paid. So that's why it's less work, and that's why everybody does it, because they're both accepted under GAAP. The indirect method is much more difficult technically, because they usually, when they ask for a statement of cash flow, they don't ask for disclosures, so you never have to do this part. This is in the operating section of the indirect method. It's a disclosure in the direct method. Since they don't ask for you typically for disclosures for the statement of cash flow, you would never have that. So the indirect method is much more difficult to prepare. So if they're going to ask a simulation, they could ask both. If they're going to ask direct method, it'd probably be in a block of multiple choice, which I will show you how to do. All right. Now, let's talk a little bit about the investing activities and the financing activities. If the operating activities focuses on the income statement, the investing and the financing activities focus on the balance sheet. The investing activities focus on what's going on in the assets. So the investing activities are over here. So I'll just sort of squeeze this over and say that this is investing section. It looks at the changes in the assets, but not the current assets, mainly the long-term ones. And then financing. How do you find, remember, the assets equals the liabilities plus shareholders' equity. Now, I'm a terrible artist. I hope these things even look equal. How do you finance your business? You're either going to borrow money, which is a liability, or going to issue stock. So this section, this side, is going to be in the financing activities, okay? Now, they do give very good examples of this. All right. They do give very good examples in your book about the operating, the investing, and the financing activities, and we're going to take a look at that in a minute. But first I want to do a multiple choice question on this. Let's take a look at multiple choice question number 3, please. Number 3. It's still just about cash equivalents in the different sections of the statement of cash flow. Number 3 is found on page 626. Number 3 says, how should the purchase be reported in Men's statement of cash flow? The Mend Company purchased a 3-month U.S. Treasury bill. Mend's policy is to treat as cash equivalents all highly liquid investments with an original maturity of 3 months or less when they purchase it. How should this purchase be reported in Mend's statement of cash flow? So basically, they bought a 3-month Treasury bill. Is this an outflow from operating activities? Remember, you have 3 sections of statement of cash flow: operating, investing, and financing. Is this an outflow from the operating activities? Is this an outflow from the investing activities? Is this an outflow from financing activities? The correct answer is it's not reported. You know why? Because a 3-month T-bill is a cash equivalent. So basically, when you purchase a 3-month T-bill, you're just swapping one type of cash for another type of cash. So guess what? It's not an inflow or outflow. It's just like debiting cash and crediting cash. It's the same thing. Because a 3-month T-bill technically is considered to be a cash equivalent. So for answer 3, the correct answer is D, like David. Here's another thing that I want to point out to you. If you have a multiple choice question and you have no idea what answer it could be, and especially when it's a question like this, which is sort of like what they call a theory type question, you have no idea what the answer is, try and look at the answers and look at the answer that looks different, and typically that could be the correct answer. Okay, so if you have to guess, but certainly don't guess A. Only pick A if you're really, really sure. All right, if you take a look so the best answer for number 3 is D, like David. Now, if you go back to page 616, on page 616, under the direct method of presentation for the operating section, the direct method of presentation from the operating section, remember the direct method of presentation, in the operating section, you're going to take each revenue and each expense and convert it from the accrual basis to the cash basis. So if you look on the bottom, page 616, they have activities that are reported on the statement of cash flow. For the operating activities using the direct method, which means you take each revenue and each expense and convert it from the accrual basis to the cash basis, cash received from customers, that's revenue. or sales. Cash received from interest, that's interest revenue. Cash received from dividends, that's dividend revenue. All of these things, sales, interest revenue, dividend revenue, they convert from the accrual basis to the cash basis. Then they have cash received from sales of securities classified as trading. Then they have cash paid to suppliers. That would be cost of goods sold. That's the accrual basis, and you convert it to cash paid to your suppliers. That's the cash basis. Cash paid for operating expenses. Those are your selling expenses, general administrative expenses, research and development expenses. Those are all examples of operating expenses. You convert them from the accrual basis to the cash basis. Cash paid for interest. That's your interest expense. Cash paid for income taxes. That's your income tax expense. And then cash paid for securities classified based as trading. Okay, first of all, it used to be, before we had standard number 159, if you purchased a security, whether it was an equity security or a debt security, meaning it was a share of stock or it was a bond, it didn't matter. If it was classified as trading, it was always going to go in the operating section. Okay, so if you bought or you sold a trading category security, then it was always the operating section. Now it's changed in standard number 159. Standard number 159 changed that. It could either be the operating activities or the investing activities based on the nature and purpose for which you purchase that investment. Okay, so the answer is it could be in the operating activities, it could be in the investing activities. It depends, and it's both purchases and sales, which they don't make very clear here. So it's cash paid for securities classified as trading, that's trading based on the nature and purpose. If they talk about cash received from sales of securities classified as trading, that's the fourth bullet under operating activities. That's also based on the nature and purpose for which you purchase securities. So when you sell them, it could also be trading or investing. You just the answer is it depends. Okay. For the investing activities, remember in the investing activities, you're going to focus on your assets. It's proceeds from sales of property, plant, and equipment. That's an asset. Proceeds from sales of investments in stock and bonds that are available for sale. Available for sale is always going to be the investing section. Cash paid for securities classified as trading, that is based on their nature and purpose. If the nature and purpose was an investing activity, then it's in the investing section. If the nature and purpose was for an operating activity, then it's in the operating section. So the answer is it depends. Proceeds from the sale or redemption of investments in bonds classified as held to maturity. So available for sale and held to maturity is always going to be the investing activities. It's never going to be the operating activities. Only the trading category is it depends. All right. Proceeds from the sale or redemption of investments in bonds classified as held to maturity. Then proceeds from collection of loans, that's the principal only. Okay, if you lend somebody money, when you lend somebody money, the journal entry would be to debit notes receivable and credit cash. That would be an investing activity outflow. Now when they pay you back, they're going to pay you both interest and principal. The interest portion would go in the operating activities because that would be an interest revenue. But the principal portion, when you debit cash, you're going to credit notes receivable and credit interest revenue. So the interest revenue goes in the operating section, but when you credit the notes receivable because you're debiting cash and they're paying you back the principal on that note, that would be in the investing section because the notes receivable would be an asset. So the proceeds from the collections of loans, the principal only, remember the interest would go in the operating section. Proceeds from selling components of your company. So if you have a discontinued operation and you sold a discontinued operation, that would be considered to be an investing activity. Then the acquisition of property, plant, and equipment, that would be a cash outflow. So if you purchase property, plant, and equipment, that would be cash outflow. If you take a look on page 617, acquisition of investments in stocks and bonds that are available for sale and held to maturity. Remember, when you buy or sell anything that's available for sale and held to maturity category, that's always in the investing section. Only the trading category is maybe it could be operating, maybe it could be investing. It depends. Making loans to other entities, as I said, when you debit notes receivable and credit to cash, that's an investing activity because the notes receivable are part of the assets. That's just a cash outflow. And if you purchase another business, so if you buy another business, that's considered to be a cash outflow, but it's the investing activities. So those are your investing activities. Remember, they focus on the assets. Then you have your financing activities. The financing activities really does focus on how you finance your company, whether you borrow or you issue stock. So anything having to do with liabilities, particularly long-term liabilities and anything like notes payable for shareholders' equity, anything having to do with shareholders' equity, issuing stock, purchasing treasury stock, selling treasury stock, paying dividends, because dividends come out of retained earnings, that would be considered to be a financing activity. So under your financing activities on page 617, under your financing activities you have proceeds from issuing common and preferred stock, because you're debiting cash, you're crediting common stock, or crediting preferred stock. Then proceeds from reissuing treasury stock. When you reissue treasury stock, you're debiting cash, you're crediting treasury stock. Proceeds from issuing short-term debt, as long as it's not accounts payable, but short-term debt like short-term notes payable, that's a debit to cash, credit to notes payable. Proceeds from issuing long-term debt, such as bonds payable, debit to cash, credit bonds payable. Remember, these are all liabilities, so that's why they're financing. Then paying cash dividends. These are now all cash outflows. Paying cash dividends. Cash dividends are paid out of retained earnings. That's shareholders' equities. That's the financing section. Purchasing treasury stock. When you purchase treasury stock, you're going to debit treasury stock, credit cash. That's a financing activity for your cash flow. It's a financing activity. It's a net cash outflow because you're crediting stock. Paying principal on your short-term loans. So if you pay off a loan, and you pay it off, and you pay off both the principal and the interest, you're going to debit interest expense, debit notes payable, and credit to cash. Only the debit to notes payable, because the notes payable is a liability, only that debit to notes payable is financing section. The debit to interest expense would be in the operating section, because the interest expense is found in the income statement, which is the operating section. All right. Paying your long-term loans, including capital leases, also bonds payable, when you pay the principal and your bonds payable, those are all considered to be financing activities. But remember, and the interest component is an operating activity. Then finally, you have your significant non-cash investing and financing activities. Remember that under both methods, both the direct method and the indirect method of presentation, you have to disclose your policy, treatment, and definition for your cash equivalents and your significant accounting policies, plus you must disclose your significant non-cash investing and financing activities. Examples of these are, I'm looking at the first bullet, about 1/3 of the way down the page on page 617, acquiring an asset through a capital lease, conversions of debt to equity, also converting preferred stock to common stock, converting bonds payable into common stock. These are all examples of significant non-cash financing activities. Exchanging non-cash assets or liabilities for other non-cash assets or liabilities. We talked about that in Module 9 when we discussed exchanges of non-monetary assets, non-monetary asset transactions, where exchange an old truck for a new truck. That's considered to be a significant non-cash investing and financing activity if there's no boot, no boot associated with it. Also, if you issue stock to acquire an asset, like if you issue stock to acquire a building, where you would debit building, credit common stock, credit additional paid-in capital, because this person wanted to invest in your company and you wanted to make them a shareholder, but they didn't have any cash to give you. They gave you a building instead. That's another example. Oh, folks, here's another example. Remember when we had a troubled debt restructuring back in Module 11C? We had troubled debt restructuring, and when we did the troubled debt and we did the settlement of the debt, and we either gave them stock or we gave them an asset to settle our debt, that's considered to be a significant non-cash investing and financing activity, and it's from both points of view. From the point of view of the debtor, because the debtor got rid of their note payable, all right, but they also got rid of an asset or common stock. They sold some of their stock, all right, in exchange for it, because there's no cash exchanging hands there. And then it's also from the point of view of the creditor, because they gave up their notes receivable, which is an investing activity, okay, and they exchange it in exchange for another piece of land, like we did, I remember in 11C, we swapped a note receivable for land, okay, for a real estate transaction. That would be also a significant, or if we gave, or if we accepted stock in payment of the note receivable, and we forgave the note receivable, that's a settlement of the debt. Once again, settlements of the debt with assets or stock are considered to be also a non-cash investing and financing activity. So I want you to write that down there. Remember the exchange of non-cash assets or liabilities for other non-cash assets or liabilities. We did that in Module 9. That was the exchanges of non-monetary assets. We exchanged an old truck for a new truck. Also, when it says conversion of debt to equity, that's when you convert convertible bonds into shares of common stock. We talked a little bit about that in Module 13 with earnings per share. Also, if you convert convertible preferred stock to shares of common stock, that's another example. We also talked about that in earnings per share in Module 13. Okay. Then they have a little blurb here about standard number 159. It says standard number 159 amended standard 115 and it permits cash flows from trading securities to be classified as operating or investing activities based on the nature and purpose for which the securities were acquired. Don't forget that. Available for sale and held to maturity is always the investing activities, but purchases and sales of trading, it depends. It could be operating, it could be investing, depending on the nature and purpose for which the securities were acquired. All right, let's take a look at some multiple choice questions and see what we can do with some of these, okay? Let's take a look at multiple choice number 8, please. Number 8, we're going to do numbers 8 and 9. So let's do numbers 8 and 9. Numbers 8 and 9 are found on page 626. Numbers 8 and 9 on page 626. Number 8 says, in a statement of cash flow, what amount is included in the investing activities for the above transaction? And number 9 says, in a statement of cash flow, what amount is included in the financing activities for the above transaction? And it always helps to think about things as happening in journal entries, folks. You can never go wrong by referring transactions back to one of the 3 principal financial statements, the income statement, the balance sheet, or the statement of cash flow, or the footnotes that are related to that item, because remember, the footnotes are an integral part of the financial statements. You can never go wrong with a journal entry. You can never go wrong with a T account. Items 8 and 9 are based on the following. A company acquired a building, paying a portion of the purchase price in cash, and issuing a mortgage note payable to the seller for the balance. Okay, number 8 says, in the statement of cash flow, what amount is included in the investing activities for the above transactions? Number 9 says, in the statement of cash flow, what amount is included in the financing activities for the above transaction? Now, typically, whenever you buy real estate and you have to borrow for it, there's typically 3 parties involved. You have the buyer, you have the seller, and then you have the bank. And the bank is financing the buyer. And what happens is that then the mortgage company, the bank, then takes a collateral interest in that mortgage. The thing is that there is no bank in this example. They're financing it directly with the seller. So it's seller-based financing. That's why they're issuing the mortgage note payable to the seller. So there's no bank involved here. So there's only 2 parties here, the buyer and the seller. The way you would think about this is that they said that they acquired the building, they paid a portion of the purchase price in cash, and they issued a mortgage note payable to the seller for the balance. All right, so if I was going to think about the way that transaction looked, I'm going to keep my little goofy Easter eggs right here. What would happen is I would debit the building. Let's just say the building was 100. And I put down cash, a down payment of 10%, so that's 10. And then I credited mortgage payable for the balance, so that's 90. When you look at this, you can really take this type of transaction, you can really divide this into 2 separate transactions. The 2 separate transactions would be to debit the building for 10 and to credit the cash for 10. And to debit the building for 90 and to credit the mortgage payable for 90. So then you can see really clearly what's the cash portion and what is the non-cash portion, okay? The cash portion here, where you debit building and you credit cash. Whenever you debit or credit cash, this has got to be reported in the statement of cash flow. This would be a investing activity because you have the building and that's involving your assets, okay? Now over here, when you debit the building for 90, and you know when you debit building 10, you debit building 90, that's a debit to building that's 100. This, by the way, is called a compound journal entry, and I've just taken the compound journal entry and put them into 2 simple journal entries, which means an equal number of debits and credits. This is an unequal number of debits and credits, so I have 1 debit and 2 credits. So here I'm debiting building for 90 and crediting mortgage payable for 90. This is exactly the same as this. As a matter of fact, most accounting systems can't even handle a transaction like this. Most accounting systems have got to only have simple journal entries with an equal number of debits and credits. Okay, so 1 debit for every 1 credit. And you can see that there's no cash going on here. Okay, that's because this is considered to be a significant non-cash investing and financing activity. Now, why would you want to report this as a significant non-cash investing and financing activity? Why would you want to report this significant non-cash investing and financing activity for both methods of presentation on the statement of cash flow? The reason is because the statement of cash flow is supposed to help you assess the amount, timing, and certainty of current and future cash flows. And even though you're not expending any cash for this mortgage now, what are you going to have to pay for the mortgage in the future? You're going to pay cash on that mortgage. So you're just trying to disclose that as a significant non-cash investing and financing activity in this period, because in future periods you're going to have to pay the mortgage payable with cash. So let's answer the questions. Number 8 says, in a statement of cash flow, what amount is included in the investing activities for the above transaction? Well, that would be the amount of the cash, which is 10. That would be the investing activity, all right, because that's building, and that would be over the assets. So the best answer for number A would be the cash payment. You can choose A, but you have to be sure. Let's take a look at number 9. In a statement of cash flows, what amount is included in the financing activities for the transaction? Is there any cash going on here with the financing activities? Are we affecting any liabilities or any shareholders' equity in here? Is there a debit to credit to any liability or shareholders' equity here that involves cash? No. This is a significant non-cash investing and financing activity. That's a disclosure for both methods of presentation. So what goes into financing activities? Nothing until you actually pay the mortgage payable, which you haven't done yet, okay? Because you just got the mortgage. So number 9 says, in the statement of cash flow, what amount is included in financing activities for the above transaction? The answer is answer C, 0. There's just a disclosure for the mortgaged amount, okay? It doesn't go in the financing activities. It goes as a disclosure, okay? Let's see if we can do multiple choice number 11. Now, I do assign number 11 and 12. I'll write those down for you next time, but I just want to do number 11 for now, okay? Number 11 says, you can do number 12 on your own. Number 11 says, what amount should we report as net cash used in investing activities? All right, if you look at number 11, it says net cash used. That's because you're supposed to take the cash inflows and the cash outflows, and you're supposed to net them together for each type of activity. So you have 3 types of activities: operating, investing, and financing. You have the cash inflows and the cash outflows. For each activity, you net them together. If, when you net them together, you have a net cash outflow, meaning that the outflows are more than the inflows. A net cash outflow means cash used. If, when you take the inflows and the outflows for a particular activity, operating, investing, or financing, and you net them together, say in the financing section, and you have a net cash inflow, then we call that cash provided because it's positive. And let them help you on these questions. If in multiple choice number 11 it says, what amount should we report as a net cash used in the investing activities? Let them help you. That means that the cash outflows are more than the inflows. So you're trying to calculate a negative number. Don't be trying to calculate a positive number. Now, I assigned you number 12. I'm not going to do that one. I want you to do that one on your own. If in number 12 says, what amount should we report as cash provided by financing activities? That means you're calculating a positive number. That means the outflows are more than the inflows because this is cash provided. So let the stems help you. That's why it's so important to read the stem first. So for number 11, it says at the bottom, page 626, items 11 and 12 are based on the following. In preparing its cash flow statement for the year ended December 31st, 2008, the Reeve Company collected the following data. They had gain on the sale of equipment. The gain on the sale of equipment is not a factor. If we're going to call this an investing activity, we'd be looking for the cash for it, okay? Proceeds from the sale of equipment. The proceeds are the cash. Now that would definitely be an investing activity for the $10,000. So you ignore the $6,000, you want the $10,000. Then they say purchase of AS Company bonds, par value of $200,000. Okay, that would be an investing activity, all right? Amortization of the bond discount, that would actually be an operating activity. Okay, but only in the indirect method. We're only taking a look at investment. We're concerned about the investing activities, so we're concerned about the assets for those of the investing activities. That wouldn't be involved in there. Dividends declared. Well, paying dividends is paying them. Declaring them is just incurring a liability, so that's not cash basis. The dividends paid would actually be a financing activity because it comes out of shareholders' equity or retained earnings. All right, and then they have proceeds from sale of the treasury stock. Once again, the treasury stock is part of shareholders' equity. That's a financing section. So if they want to know what amount, purchase of AS Company bonds, par value $200,000. I missed that one. Purchase of AS Inc. bonds, par value of $200,000. So we're buying another company's bonds. That's definitely in the investing section. Okay. So in its December 31st, 2008 statement of cash flows, number 11 says, what amount should we report as net cash used in the investing activities? Once again, we don't pay attention to anything in the GALE. The proceeds from the sale of equipment is the investing section, and that's a cash inflow for $10,000. The purchase of the bonds, now bonds are an investment, that would be in the investing section, and that's a cash outflow. And all the other ones are financing activities, or they might go in the operating section. So the only two investing activities are going to be the proceeds from the sale of equipment for $10,000 and the purchase of the AS Company bonds. That's an investing section because it's an investment of negative $180,000. So positive 10 and negative 180 is negative $170,000. So it's already, they say it's used. So all these numbers already are negative. So number 11 says, what amount should we report as net cash used in investing activities? It's positive 10, negative 180. So it's negative 170. It's used, so the correct answer is A. You're allowed to choose A, but only if you're sure. Now I'm going to let you deal with the financing activities on your own. Okay. Let's take a look at multiple choice numbers 14 and 15. Numbers 14 and 15. In numbers 14 and 15 on page 627, number 14 says, which of the following should be reported when you prepare a statement of cash flow? Okay. Now remember, reporting not only includes the financial statements, reporting also includes the disclosures, okay? Because the disclosures are an integral part of the financial statements. The disclosures are an integral part of the financial statements. So 14 says, which of the following should be reported when preparing a statement of cash flows? Converting long-term debt to common stock. Well, converting long-term debt to common stock is an example of a significant non-cash investing and financing activity. So do you report that? And the answer is yes, you do. You report it as part of the disclosures. Okay? Conversion of preferred stock. When you convert preferred stock into shares of common stock, do you report that? Yes, that's another example of a significant non-cash investing and financing activity. So the correct answer there would be yes, and yes, the answer then would be C. Let's take a look at multiple choice number 15. Number 15 says, which of the following information should be disclosed as supplemental information in the statement of cash flow? Which of the following information should be disclosed as supplemental information in the statement of cash flow? Do you have to disclose cash flow per share? Now here's what they're trying to do. They're trying to confuse you with earnings per share. Remember, earnings per share is required for income from continuing operations, discontinued operations, extraordinary gains and losses, and net income. You have to do basic and diluted for complex capital structures, basic only for simple capital structures. So they're trying to confuse you between earnings per share and cash flows per share. Remember, we did earnings per share as part of shareholders' equity? I did that with you, but only the earnings per share section. Phil does the other portions of shareholders' equity in Module 13. You do not have to disclose cash flow per share. So do you have to disclose cash flow per share? No, you do not disclose cash flow per share. Do you have to disclose conversions of debt to equity? The answer is yes. When you convert debt to equity, and the journal entry would be the debit bonds payable, credit common stock, credit additional paid in capital. As a matter of fact, we converted convertible bonds into shares of common stock when we were discussing Module 11B, and we did bonds. Okay, we also discussed converting bonds into shares of common stock. We actually did a conversion of convertible bonds into shares of common stock when we did earnings per share in Module 13. That's an example of a significant non-cash investing and financing activity and is a disclosure. So, which of the following information should be disclosed as supplemental information in the statement of cash flows? Cash flow per share? No. Conversion of debt to equity? Yes, as a significant non-cash investing and financing activity. So the answer to number 15 is C, no and yes. Okay. There's some other things that I want to point out to you. For the indirect method of presentation, turn to page 619. On page 619, in the indirect method of presentation, remember what you're going to be doing in the operating section is you're going to be taking net income and converting that from the accrual basis to the cash basis. They have that on the top half of page 619. So on the top half of page 619, they have that. And then, if you take a look, we also have that on page 20 of your financial accounting reporting handout. If you look at page 20, They first start off with net income, and they deal with a whole bunch of adjustments to reconcile net income from the accrual basis to the cash basis, okay? And I hate to say this, but you're just going to have to memorize these types of items. I hate to say memorize stuff, but you have to memorize stuff. You always have to memorize stuff in this. You have to memorize anything. I mean, before you got a driver's license, didn't you have to memorize all the dumb rules and take the test? Right? Of course, the book you had to memorize was only this thick. Now you have books that are like this thick. You take this stuff and it's like this. What can you do? We all want to be CPAs. That's what we're going to have to deal with. By the way, International Financial Reporting Standards. You know how thick it is? 2 inches. Compare 9 inches of gap with 2 inches of its international standards. So you're going to have to memorize this stuff. Let's just take a look at some of the things that you have to memorize, okay? I'm looking at then on page 20. If you look on page 20, let's just take a look at this stuff, okay? By the way, the indirect method of presentation, when you convert the net income from the accrual basis to the cash basis and you put that in the operating section as opposed to each revenue and each expense, converted from the accrual basis to the cash basis in the operating section, which is a direct method of presentation, the indirect method is much harder, okay? You start off with net income and drop down to the third item. You're going to add back your non-cash expenses. Examples of your non-cash expenses are depreciation expense, also amortization expense. Also, it's not on here, but I want you to write it down, depletion expense. It's not on here, bad debt expense. I want you to put on there bad debt expense, also warranty expense. So examples of non-cash expenses are depreciation expense and amortization expense, which are already written there, plus depletion expense, bad debt expense, and warranty expense, all right? Also, you're going to add back any losses. All right, you're going to add back any losses, but then you're going to subtract any gains. You're going to add back any losses, you're going to subtract any gains, and then you're going to add back the amortization of your bond discount. You're going to add back any amortization of bond discount, but you're going to subtract any amortization of bond premium. You're going to subtract any amortization of bond premium, okay? For the subtractions, you're going to subtract the amortization of bond premium, you're going to subtract some gains, okay? There are some other types of things that you subtract on here. Another example would be the equity and earnings of investee under the equity method of accounting. Under the equity method of accounting, when you own 20% or greater of the outstanding shares of another company, you're said to have significant influence over them. Because you have significant influence over them, you're allowed to pick up a portion of their net income as your revenue. For example, let's say you own 40% of the outstanding shares of the Beta company. Beta reports $100,000 of net income. Because you own greater than 20% of their outstanding shares, you own 40%, you're said to have significant influence over them. And under APB opinion number 18, you're supposed to use the equity method of accounting. The journal entry that you would make would be debit investment in Beta, credit equity and earnings of Beta for 40%, which is your share of their shares, 40% times 100,000, which was their net income. So you would debit and credit for $40,000. The thing is that when you debit investment in Beta and credit equity and earnings of investee Beta, that $40,000 is considered to be a non-cash revenue. Well, if you add back the non-cash expenses, then you subtract the non-cash revenues. What you're trying to do when you convert the net income from the accrual basis to the cash basis, what you're trying to do is take net income on the accrual basis, then you're going to have a bunch of reconciliation, adjustment, or they call it adjustments to reconcile net income to cash from operating activities. And what you're going to do is you're going to add back all your non-cash expenses like depreciation expense, bad debt expense, amortization expense, warranty expense. Because once again, remember what net income is. Net income is revenues minus the expenses equals your net income. You've subtracted all these non-cash expenses. So net income includes a subtraction of all those non-cash expenses. To convert net income to the accrual basis, you have to add back all those non-cash expenses, okay? You have to add back the amortization of the bond discount and you subtract the amortization of the bond premium, okay? If you Then you have to you subtract the losses and you add back the gains. By the way, when you subtract the losses, not all losses are subtracted. There's some special losses that you don't subtract, okay? There are exceptions. Special losses would be like losses that you incur when you mark your inventory down to the lower of cost or market. You don't consider that loss. Also, other losses such as long as you do not elect the fair value option under standard number 159 and you follow standard 115, the unrealized holding gain or loss on available for sale securities, that unrealized holding gain or loss goes to other comprehensive income. It never goes to net income. So that type of gain or loss never factors in here. So you don't add back that loss and you don't subtract the gain from unrealized holding gain or loss on available for sale securities, as long as you do not elect the fair value option. Okay? What I want you to do is I want you to study what's going on in the handout on page 20. It's a little bit shorter, this list. And then I also want you to look at the longer list, which is the top of page 619. And when I come back on the next desk, I'm going to go over some multiple choice. I'm going to show you how to convert net income from the accrual basis to the cash basis using a series of the adjustments to reconcile net income to cash from operating activities. But that will do you no good unless you memorize the list. So page 20 is a more general list. The top of page 619 is a more specific list. So I need you to take a look at that. Okay? So memorize those lists, and then I will see you on the next disc, and we'll do some multiple choice.